Hi, I'm Khleif. Each and every week, I record an interview with a thought leader that I know you're going to get a ton of value from. Now, here on YouTube are the video versions of my podcast, Lifetime Cash Flow Through Real Estate Investing. Now, to make sure you get the latest information, please subscribe and hit the notification bell. Let's get started. Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Khleif, and I am thrilled you're here. And I know you're going to get tremendous value from the young lady we're interviewing today. Her name is Sarah May, and I'm just always so excited when we get a woman on here that's making things happen in this business. So Sarah was in corporate aerospace, has left that to be a full-time real estate investor. She now has 300 units as a GP in Colorado, and then as a limited partners in another 600. And I just closed on a deal in Colorado Springs, which I know well and have been many times. So we're going to dig into all of that. Welcome to the show, Sarah.
Thanks, Rod. Thanks so much for having me.
Absolutely. So super excited to dig in on how you made this happen, and and hopefully inspire other women to get into this business, more women to get into this exciting business. So let's start by having you tell my listeners a little bit about how you got started, why real estate from aerospace. That's quite a shift. And, just give us a little more of your story.
Sure. So I actually got interested in real estate way back in college when I was getting that aerospace engineering degree. And, it took me a while to actually go for it, but I studied and learned and educated myself on real estate while I was working in corporate America for about 10 years. And during that time, kind of started small and did what I could on my own. So save up the down payment, buy a small multifamily, usually 2 to 5 unit type size. Try to do that a few times a year, and just was scaling organically, but slowly. And then about
in Denver, or where were you at the time?
In Denver. Pretty much all our properties are in Denver. Okay. And after doing that for 5 or 6 years, started thinking of how to make it more of a business. We'd had some, when I say we, I mean me and my husband, had some success on the small scale and wanted to go bigger. And so learned about syndication and how to partner with other people who wanted to own real estate to do bigger deals and get better returns. And I've been doing that as my primary focus for the last 3 years. And, like Rod said, we have 300 units that I actively operate and manage as a syndicator, and as well as some passive investments. So I know how to look at deals from the passive side as well. And the great thing about real estate is it is, a little bit of a flexible schedule. I have 2 young sons, and I'm able to spend quite a bit of time with them too. So it's a great business.
Love it. So did you start passively?
I did. I think I was in 3 passive deals before I ever sponsored.
Right.
One.
And guys, that's not an uncommon path, is to start passively. In fact, a lot of people start that way for a lot of different reasons. You learn the business. It actually goes on your resume's experience. And it's a great way to get kind of some behind the scenes training and really see how things work in the business. We talk about that regularly on the show. Now, I know I met you in Denver in advance of my Denver event, because I did a meetup with Adam Adams out there and got to meet you there, and that's how we met. So I've been pushing to have you on the show, and I'm just thrilled that you're here. So you did this with a family with 2 sons, and you started with small properties. What was your first larger deal as a GP?
Sure. So the first larger deal we bought about a little over 2 years ago. And there were 4 GPs on the deal. Me and my husband are the primary asset managers, being boots on the ground, local to the property. It's 100 units in Aurora, Colorado. And it's, it kind of fit the formula that we were looking for: class B-, 100 units, value add story, management's, managing it a little better story. And that deal's done really, really great. We've been able to deliver the returns to our investors, and as well as see the community improve. And it's been a great deal.
Wow, crazy hearing about an Aurora property on the show, just because I have owned hundreds of properties in Aurora. So anyway, talk about the business plan on that specific deal, because I know guys, like any business, you have to create a business plan for your property. You have to tell a story, and you have to have a reason to take down a property and speak to what you're going to do with it. So talk about the business plan on that one, if you don't mind, or you can pick the one you just put under contract if that's easier for you. It doesn't matter.
Sure. So our business plan with that Aurora deal was primarily focused on renovating and raising rents. So we knew that 30% of the units were townhomes, and those were just $300 a unit per month under market. Wow. As is. So that was a huge bump to our income that we knew right away we could get. And then across the portfolio, by renovating, putting $6,000 or $7,000 into each unit, we could get $80 to $100 for, all 100 units at the property. So on average, I think it was around, I want to say, $200 to $250 that we could get with the increase in market rent, the increase in renovation, as well as just bringing rents up to market and getting rid of the loss to lease at the property. So that was the primary aspect of our business plan, was just raising rents to market levels. But we also wanted to do some things to improve the property. So we, got new signs out at the property, did some landscaping work. We also wanted to do some green improvements to cut our energy usage. So we put all new LED fixtures, exterior and interior in all the units. And so that cut our electricity bills.
Did you utilize the green program with Fannie or Freddie, or Fannie rather?
Didn't. They had just switched it to the more stringent requirements.
30%,
we didn't want to have to invest a bunch in energy.
Okay. By the way, guys, what I'm talking about here is the agency debt you can capitalize on what's called a green program, and if you hit targets in energy savings, you actually get some basis points off your loan, which can be a big deal. I remember there's 100 basis points in every 1% in interest, so it can be as much as 20 or 30 basis points savings, which in a big multi-million-dollar loan is a big deal. So, but anyway, please continue. So you made some green improvements.
Yeah, and so now over 2 years later, we've been able to increase the net operating income at the property. So we've raised the rental income, we've raised the other income by adding carports and things like that.
Oh, you did?
We did, yeah. So that's $30 a month per spot by adding carports. And then we've been able to manage the expenses of the property pretty well, and have stayed the same or just had slight 1 or 2% increases per year. So our net operating income at the property has increased about 23 to 25% in the couple years that we've owned it. And what that corresponds to is an increase in value, since these large multifamily properties are valuated based on your net operating income. So all things being equal, we've raised the net operating income by 25%. Our value of our property should go up 25%, assuming the same cap rate of the market as when we bought it.
Right.
Story.
And let me ask you this: are you using third-party property managers there?
Yep, we are. We're using a third-party company, and they keep the property nice and clean. They collect the rent, deal with delinquency, maintenance issues, everything else. So it's great to have a third-party manager. That's not one of my strengths, so it's great to pay someone to do a good job there.
Okay, I love it. So I know that you just took down 189 units in Colorado Springs. I've stayed at the Broadmoor Hotel there, been up Pikes Peak many times, love it. So it's kind of cool to visualize the area. Tell us about that deal.
Yeah, so that one's an exciting deal. It was an off-market deal, so we were able to.
How'd you find it?
Put in an offer. It had essentially networking with brokers really was the bottom line. I had coffee with the 2 listing brokers who were going to be the listing brokers, and just told them again what we were looking for, and they said they had an opportunity that might be coming up, and if we wanted to make an offer, they could probably get us a property tour. So just went along that route and saw the property, submitted an offer that was in the range that the seller would accept, and started negotiating from there.
Fantastic, fantastic. Now, any nuances about the business plan on that specific deal that could be different, or is it pretty much the same? Renovate units, get rents up, and increase the NOI.
One thing that's different about our business plan on that property is they're not currently having tenants pay the utility bills. On a lot of properties, you have a RUB system, is what they call it, a ratio utility billing system that the property management company will put in place. And what that does is it just divides up the property's utility expense and then bills it to the residents to essentially pay for their share of the utility usage. And this new property in Colorado Springs, they aren't currently doing that. And they are charging a small flat fee for utilities, but it's really, the tenants think of it more as being wrapped up into rent, and they don't even think they're paying anything for utilities. So by changing over from almost a no utility billing to over time billing up to 100% or near 100% of the actual expense of the property, is just going to be a huge driver to net operating income. Interesting.
So you know, and guys, the reason that's a big deal, obviously, and maybe it's not obvious, but if a resident thinks their utilities are included, they don't care if the window stays open when it's hot or cold outside. They don't care if the water stays running. None of that matters. So not only when you bill back are you go straight to the bottom line, but secondarily, if the tenant knows they're responsible, they're going to be much more conscious of it. Now, so there. Is it going to be all utilities? Is it mostly water? Is it what are you going to bill back?
So the property is master metered for pretty much everything. So it's going to be water, sewer, trash, electric. There's not much gas, but gas will be included. And the other thing our property manager recommended that we do is charge what they call a CAM fee, or a common area maintenance fee. And there's quite a few common spaces. There's a club room and a lobby, fitness center, indoor pool. And so by charging just a nominal fee, I think it's $10 or $15 a month per unit, some of those expenses for maintaining those areas get covered as well. And so we'll be adding that in with the bill that the residents get charged each month. And so that'll be another additional revenue source at the property.
Nice. Now, guys, with RUBS or any bill back system, you want to be careful if you are the groundbreaker in that community with your competitors to institute that program. And I don't know what the case is for you on this one, Sarah, but if you're the first one, you're going to have some vacancy. If you're not, then the market is already pre-framed to have to pay for utilities. So keep that in mind, guys, when you're looking at these. Now, is your skill set the analytics or the investor relations, or what would you say your superpower is, Sarah?
Originally I would say analytics. Being an engineer, I love the numbers and put a spreadsheet in front of me and I can have fun for hours, sort of deal. But I really love the investor relations too. I mean, I go to all kinds of networking events and meet people and hear their stories. And, ultimately, one of the missions of our business is to help people own real estate who otherwise wouldn't. And by being able to give them sort of a hassle-free solution. I really like both of them, but probably the analytical is the one I swing towards a little bit more.
Sure. Is it just you, or are there other people on your team? Is your husband involved? Or
yeah, so my husband Alex, he works with me in the business. I'm maybe the primary point person for a lot of this, but he works part-time in a 9-to-5 job right now.
Okay.
So usually I'm the one here able to get stuff done and operate the properties.
Sure. So how do you feel about where we are in the market cycle right now?
I get this question a lot, and I think my answer is, as an investor, I just want to take things slow and steady. Nobody really knows if we're at the peak of the market or if we still have another 5 years left before things start tapering downward. So for me, I'm not in a huge rush to collect thousands of doors right now. The deals I do want to do are the ones that are safe and conservative, that have lots of cash flow. So if, occupancy drops in a recession, you can still have adequate cash flow to cover your expenses and your debt payment. So, I still consider myself a buyer even in this market, but it just has to be the right deal.
How do you stress test the deal, Sarah?
Usually ones on occupancy and economic occupancy. So, what's the total loss that you can withstand each month and still cover your expenses? So I like to stress test it that way. Another way is on the reversion cap rate. Right now in Colorado, properties are selling at 5 caps, but historically, maybe it's closer to a 6 or a 7 cap rate. So if I did have to sell at a non-optimal time in the future where the cap rates are higher, how high could the cap rate be and still, at least break even or have a small profit? So those are 2 ways I stress test deals. The other way, just anything that I would look at would need to be in a strong market. So the criteria I look at with markets are strong population growth. So people are moving into town, they're not, flocking away. Strong job growth. So new employers are coming, jobs are being created. It's just a sign of a healthy economy. And then the third one is business and landlord friendly. So states where it's, there's not tons of rent control laws, for instance, that would be a non-landlord friendly state. Places where, for me, I like lower property tax states, although that's a little bit of a difference. But, landlord and business friendly states, ideally in a larger metro of 100,000 people or more. So deals like that, I'd say still can fit the box, even though people are predicting we're near the top of the market.
Or already crested. Yeah.
Right.
Yeah. It's interesting. I got real sticker shock when I came down here on the property taxes. I was used to Denver property taxes, and oh my God, because we have no state income tax here, so it was a real eye opener for me. Now, let me ask you this: starting out in this career of yours in real estate, did you have any aha moments? It's like, wow.
Yeah, I think the biggest one is just you have to form a team around you and you can't go at it alone. And I probably learned that, call it 5 years ago, when I was self-managing all of our smaller rental properties. And, there's always something when you're managing properties. And we didn't even have a lot. It was, 20 units or so, but self-managing them. And finally had a tenant situation where it just was like, we cannot personally be involved with this person. We need to hire a property manager to take over, remove ourselves from the equation, and then, eventually get them out of the unit. And we did that, and it was like such peace of mind and weight off of our shoulders. It was amazing. And from then on, we just switched all of our properties over to property management. And, just, I'd say that specific story just made me realize that, you can't go at it alone. It's a team sport. Work with good people. They'll make your life easier, and it's more fun along the way.
Yep. What would you say is the most challenging part of your role in what you're doing now?
Oh, to pick one. Yeah. I think it's just the, I don't know the right expression, but in engineering, we called it herding cats. So there's just a lot of moving pieces to everything that you do.
Pushing a rope. Pushing a rope.
Yeah, exactly. There's just a lot of details, things to keep track of, people to communicate with. And, when I try to pride myself on communications and being detail oriented and the asset management of things. So there's just, whether it's a rehab project or a finance question or an investor question or needing to get out investor reports, like there's always something to do. But at the same time, that's almost what I love about it too, is that you're never doing the same thing 10 hours a day. Every day is different, and there's new and exciting challenges to look forward to.
What's your favorite? You told me the challenging part, which is the extremely high level of details. Got it. Herding cats is a great expression. What's your favorite part? Is it the analysis? Is it the finding a deal hunt?
The deal hunt is fun for a while,
Right.
but it does get tiring after a while. It took us a year to find our last deal. I think my favorite part is just seeing the transformation after you have a deal, and then getting to see your business plan played out. We've kind of seen that at our first property, and now our second property. We've only owned it a little over a month, I guess almost 2 months now, but we're already, doing a full exterior paint. We're changing policies. We're making the community more vibrant and holding a 4th of July party. And it's just, these little things that you can do that make such a difference and give, the people who live there a little pride in their unit, and that they live at the property, making it more enjoyable for the people who work there too. And then obviously the investors that partner with us, doing a good job for them as well.
So the fact that you live, it's your backyard, you live in Denver, it really speaks to the importance of lifestyle for you, because you could certainly do the property management, since you've got staff at both of those properties, but it's like, you don't want those phone calls that the problems are happening all the time. You let someone else deal with the detail. I totally get it. So if you could go back and tell your 20-year-old self something, of course that's just a year, but for you, of course. But, yeah, if you could go back and tell your young self something about this business, what might you do differently with what you know now?
Well, the easy answer is buy everything. I would have told myself back then. I think I started buying right after the crash, so it would have been a great time to buy as much real estate as humanly possible. But that's the easy answer. I think the other answer would be surround myself with good people. I always was kind of the academic, go at it alone, do everything myself type person, and having that realization that you get a lot more done a lot faster when you partner with people. I would have tried to get my younger self to understand that, and find good people to work with, and work
good.
with
Solid advice. So, I'm sure that you do some mentoring as well, because I could just see that in your personality that, that you recognize you've got two hands, one to pull yourself up and one to help other people up behind, underneath you or next to you. What words of wisdom do you typically share with aspiring multifamily investors? What sorts of things do you tell them? You've already shared some of them. Obviously, that this is a team sport. There's no question that this is a team sport. What else? What other advice might you give them?
I just want people to know that it's possible, and you don't have to start with a 100-unit multifamily apartment building to do well in this business. Start with a duplex, even live in half of it if you need to, but you can start where you are and find creative ways to get your feet wet. Also, I think it's valuable sometimes. In those early years that I had and with self-managing, it's painful, but you do learn a lot. So, put yourself out there, try as much as you can, learn as much as you can, and, the other piece of advice I like to give people is find your investor DNA, is what I like to call it. There's so many ways that you can get involved in real estate and make money in real estate, but ultimately you have to enjoy it too. So figure out, one, something that you enjoy doing, and then two, something that will make you money the way you need it to be made. So whether that's, if you need money right now, maybe you want to be a wholesaler or a house flipper. If you want to do more long-term, less work investing, then you want to be, buy and hold rentals. But know your investor DNA. Look at a lot of different opportunities for how you can make money in real estate, and then pick one or two and really specialize in those. Learn as much as you can about them, and then at that point, pull the trigger and take action, and you won't regret it.
Yeah. Sound advice. So, do you have any quotes hanging on your wall, or quotes that jump out at you?
Quotes? Oh, you're the quote person, Rod.
I'm a quote person.
I think the one I always think of a lot is, whether you think you can or you think you can't, you're right. And if you believe in yourself and what you're capable of, there's really no stopping you. The real variable is just time and how long it takes you. But if you believe you can do it, you will do it. So, think positively, have a good mindset, and you'll get there.
Love it. I just literally said that quote on our coaching call before we did our call here. Literally the exact same one I just shared with my team, with my coaching clients. And we were talking about the importance of learning how to influence. And I mean, sales, bottom line, it's sales, but the importance of learning how to sell yourself and sell in general. And that was, I ended the whole conversation about, how to influence and build rapport and how important it is with that quote, which is one of my favorites as well. Love it. Well, listen, Sarah, I really appreciate you being on the show. You've added a lot of value, and it's just so wonderful to see what you've done in your career so far. Let me ask you one. Actually, let me follow up with a couple last questions here. Tell me about a mistake. Tell me about, I hate to call them failures. I call them seminars, but tell me about a seminar. Tell me about something that really kicked your butt and what happened and what you did.
Well, I'll give one example that I think could be an example for syndicators of how to structure their capital raise a little bit. Okay. But the first deal we did, me and my partners spent a lot of time putting together this webinar with all the information on our business plan and what we wanted to do. And we had the webinar, and it was received with tons of enthusiasm, lots of people wanting to invest. It went really well. But we didn't have the subscription documents ready in time. And so we forced people to wait about a week before those documents were ready. And in that course of a week, a lot of other syndicators, we had all announced deals. So we lost some of that momentum that we would have had if we had had those documents ready at the time we had the webinar, which essentially kicked off our capital raise. So that was a learning experience. You want to do as much work up front as you can on the capital raise of these deals. Just makes things go a lot smoother, and have your paperwork ready.
Yeah, no, that makes sense. Well, listen, Sarah, thank you so much for being on the show. Greatly appreciate it. It was my absolute pleasure to meet you in Denver, and I'm sure we'll stay in touch. Good luck in all you do.
Oh, thanks, Rod. Really appreciate it. Great being on the show.
All right, take care.
Hey, thanks for watching. Please subscribe to my channel. And if you listen to podcasts, join me on iTunes, Stitcher, or wherever you listen to those podcasts. Just search for Lifetime Cash Flow through Real Estate Investing.